The market for ARWA Inc, or YYAI, is currently closed, with the last reported trade taking place at the NASDAQ exchange on October 23, 2025, at a closing price of $0.0934 per share. This price represents a dramatic single-day drop of over 50% from the previous session's close, a plunge that immediately highlights the extraordinary, almost seismic volatility surrounding this stock. When you see a price movement like that, especially for a stock trading in the micro-cap range, the first most common expectation is that the company has announced some catastrophic, completely unexpected failure, a lost contract, a lawsuit, or an internal implosion. That is the surface-level market read, and if you stop there, you miss the much more complicated and in many ways more interesting truth. The reality is that this massive recent price drop is tied directly to a previously announced corporate action, a 1-for-50 reverse stock split slated to take effect in just a few days, specifically on October 27, 2025. This move, which was approved by shareholders months ago, is a desperate but necessary measure to address the NASDAQ's minimum bid price requirement. The market's expectation is often that a reverse split signals distress, a lack of options, and impending doom, especially in the context of a stock that has fallen from a 52-week high of over $6 down to single-digit cents. Yet the deeper counterintuitive angle is that while the split itself is a sign of financial weakness and regulatory pressure, the extreme sell-off before the effective date is a pure function of arbitrage, tax loss harvesting, and technical trading mechanics rather than a fresh deterioration of the underlying business plan announced the same day. Savvy short-term traders are often racing to dump their shares, to avoid holding odd lots, or to lock in losses against gains elsewhere before the new capital structure is in place, creating an artificial, albeit dramatic, spike in supply. This is a crucial distinction. The market narrative is company is collapsing, look at the price, but the trading reality is technical forces are driving the price lower to meet a structural deadline. That tension between narrative and mechanics is where the real analysis lies for ARWA Inc stock. The recent trading history of ARWA Inc is less a steady trend and more a series of violent speculative swings driven by their highly publicized strategic pivot. Until very recently, the company was known as Connexa Sports Technologies, focused on niche sports tech and intellectual property. The whole market shifted its perception, and the stock's ticker, to YYAI, which stands for UNU, Artificial Intelligence, following their announcement of a bold, complete shift into the Web3 and digital finance space. This new focus centers on the ARWA Inc exchange, a platform for the tokenization and trading of real-world assets, particularly tokenized U.S. stocks, utilizing the Solana blockchain. This strategy was backed by a reported $100 million investment commitment from an entity called JuCoin, including a $30 million infusion in Solana tokens. The initial market expectation following the announcement in early October 2025 was one of speculative fervor. The stock, albeit at a low base, briefly spiked on the news of the crypto pivot and insider buying. This is the classic retail investor hope, the small, beaten-down company that finds the perfect buzzword or asset class to reinvent itself. The reality was a catastrophic collapse immediately following the excitement. The stock plummeted over 90% almost overnight after the announcement of a highly dilutive equity offering, which utterly shattered investor confidence and confirmed the deepest fears of skeptics. The sheer volume on these days was gargantuan, with one session seeing over 2 billion shares traded, completely decoupling the stock's valuation from any fundamental metric. When you see trading volumes that are many multiples of the shares outstanding, you are witnessing a frenzy of short-term speculation, not long-term investment. This trading dynamic is a critical factor for anyone using individual brokerage platforms or online investment tools to track stocks like this. It is a cautionary tale of how quickly speculation can be priced in and then ruthlessly unwound. The institutional activity, which often relies on deeper, slower due diligence, has shown a mixed picture, with some smaller institutions reducing positions, while others have initiated small allocations, perhaps hoping to capitalize on the extreme volatility, but generally the lack of substantial institutional backing confirms the stock's highly speculative status. The core tension here is that the company's business model expectations are futuristic and potentially lucrative, while the reality of its financial structure and market perception is currently toxic. On one hand, the concept of a decentralized 24/7 exchange for tokenized U.S. equities, leveraging the speed of Solana, is a genuinely novel approach that could appeal to the millions of users already engaged in the digital asset ecosystem, a market that traditional finance, even platforms like Fidelity or Interactive Brokers, are still navigating cautiously. The idea of tokenized stocks, where a digital token represents a share, allowing for instant settlement and fractional ownership in a way that goes beyond the capabilities of even Robinhood's fractional shares, is a compelling vision. This is the expectation. The reality is that the company, even before the catastrophic price drop, was a micro-cap with significant operational losses and a troubling balance sheet. The reverse split, while technically intended to preserve the NASDAQ listing and perhaps make the stock marginally more appealing to institutional investors who have mandates against buying penny stocks, is overwhelmingly viewed by the broader market as a sign of desperation. The company's reported Q1 2026, ending July 2025, showed positive net income, but this was largely an accounting event, and cash from operations remained negative. The total outstanding shares were astronomical before the split, contributing to the low public float volatility that the company itself acknowledges as a major risk in its forward-looking statements. Anyone looking for investment help in this space needs to clearly separate the compelling narrative of the ARWIA Inc. exchange from the brutal financial facts of ARWIA Inc., the publicly traded entity. The sheer distance between the potential of the former and the precariousness of the latter creates a minefield for the average person who is trying to invest online. Let's look more closely at the business pivot, as it is the sole driver of current enthusiasm. ARWIA Inc. has two main business segments. Now, there is the original legacy business, which involves proprietary technology, specifically advanced patents for AI-driven matchmaking and other solutions, primarily licensed through a subsidiary. This is the slow, steady, low-growth component, almost a forgotten asset in the shadow of the digital finance pivot. And second, and far more relevant to the stock price, is the ARWIA Inc. exchange. This new platform is designed to directly bridge the traditional financial world with the decentralized crypto world. By tokenizing real-world assets, they are attempting to create a market where liquidity is higher and settlement is nearly instantaneous, all while courting the existing user base of their partner, Jucoin. They are trying to offer something that even the sleek platforms of SoFi Invest or the established brokerage services of Fidelity Investments haven't fully committed to yet: a fully integrated, blockchain-native stock trading experience. This strategy, though highly ambitious, carries immense regulatory risk. The regulatory landscape for tokenized securities is murky at best, and the path to full compliance is expensive and uncertain. This is a significant risk that often goes underappreciated by retail traders captivated by the potential rewards. The company's own filings reflect this uncertainty, pointing to a range of potential factors that could cause actual results to differ materially from expectations. Furthermore, the reliance on a single partner's funding and the use of volatile crypto assets like Solana to buttress the exchange's financial foundation introduces a concentration risk. This isn't just a technical concern, it's a fundamental vulnerability in the business model's stability. The market's initial reaction to the business model, speculative excitement followed by a precipitous decline upon the dilutive offering, is a classic expectation versus reality mismatch. The expectation was that the ARWI ANC exchange would be funded through robust partnerships and would immediately deliver high-margin revenue. The reality was a capital raise that effectively wiped out a massive percentage of shareholder value, confirming that the company needed to sell shares at extremely depressed prices to keep the lights on and fund the transition. This is why the institutional holders are showing a pattern of reducing or simply holding small legacy positions. Major players like Geed Capital and the Vanguard Group, who manage significant Fidelity ETFs or utilize Schwab Intelligent Portfolios for broad market exposure, are not significantly involved. Their small holdings are likely remnants from the pre-pivot Connexa Sports Technologies days or are part of small-cap index tracking. The absence of new large-scale institutional buying confirms that professional investors view the situation as highly speculative and are waiting for clear evidence of sustained, profitable operations from the new ARWI ANC exchange. The